Hello and welcome back. You're tuned into ET Now, and I'm Ankita Saxena. We are taking you through all that is transpiring in the market. And remember, we are in the thick of earnings season. And right now, we're also joined by an earnings candidate, MedPlus, that has reported its Q1 numbers. If you take a look at the numbers, the revenues are seeing an uptick of 21%. Even the profit, stands at 33 odd crores. But it's the margins that's seeing a decline at 7.1% versus an 8.5% on a year-on-year basis. Let's get the management on board and find out what happened on the management front, on the margin front, and get a sense of what's going to be the growth roadmap ahead. We are joined by Mr. Gangadi Madhukar Reddy, who's the founder, MD, and CEO of MedPlus Health Services. Hello, good morning, Mr. Reddy. Thank you so much for taking the time out and joining us today. Mr. Reddy, firstly, even as your revenues grew 22%, the gross margins have been a dampener here, 24.5%. That's a downtick of 163 bips on a year-on-year basis, and sequentially also it's down 198 bips on a quarter-on-quarter basis due to weak private label share, which stood at 20%, and that's the lowest in 5 quarters. When do you see a pickup or a reversal in the private label share?
The private label actually was at its peak around 4 quarters back or 5 quarters back. And that is the time when we were really pushing hard, incentivizing our employees, and also trying to doing a little bit of ATL and everything else, ads out there to bring in new customers for that. After that, we decided that the incentives were working a little against us in the sense that employees were pushing our products too hard. So we decided to change course a little bit, and that has basically seen a positive, which is, our brand sales started going up steadily since then, and which continue to grow, and that's the reason why you're seeing the year-on-year bump. But private label, obviously, since it is not being pushed so aggressively, went down a little bit. That's a tad bit. But what also, caused this dampener was some supply side issues because of the war. Not that the war had any major stoppage out there, but some of the inputs which go into it basically became slightly more expensive. And so there was a constant, kind of conversation between us and the suppliers on the pricing of various things, including the packaging and all. Hence, there were some delays. And hence the product was also not available at full listing in our stores. Hence the private label also went down. So the product mix is what caused the overall decrease in the sales, the lessening of the private label thing. And that is a result of 2 things. One of them is addressed right now. I don't think it's an issue. And we are also now coming back with some, better plans for making sure that, these are sold at the usual level. So the downtick which you're seeing in private label quarter on quarter will probably be arrested this quarter, and probably will start seeing some growth as we go forward. But yeah, that's where it is. The other thing, that's the main thing I would say on the private label.
So, Mr. Reddy, do you expect the margins to stay under pressure for the next few quarters as well? And, as the margin recoveries remains a key overhang, could you give us some color on the guidance going ahead?
Can't really give you any guidance at this point of time, but the thing is, I don't really expect the margins to be under any pressure, because it's either we're going to be private label, which makes us good money, or it's going to be just the brands, which will increase the top line, and hence we'll still make the money. I don't think that's going to be a challenge. It'll come back on track. I don't see this to be a permanent kind of situation.
Okay. Also, let's talk about the bulk of this quarter's store additions that were franchise-led rather than company-owned. Does this signal that the COCO model no longer scales profitably?
No. The company-owned stores are actually the best way to actually grow. But the thing is, our intention is to grow the stores to a different level. And so in the long run, we expect that we will have to do some franchising stores, and franchising will become one of the major things. That's why we are experimenting with that. It is not because the company-owned stores are any less profitable or anything like that. It's just that for us to really scale, so if you have to basically grow at the level of, let's say, 2,500 or even 3,000 stores per year, that means you have to actually hire 12,000 people, train them, and put them out there in the jobs, which is kind of tough, given that most of these guys are all minimum wage employees. So for us, to manage growth or to basically take growth to a level beyond the 800, 600, 800 or 1,000 stores, which we have been doing in the past, we feel we have to do the franchising side. And that's why we are focused on it a little bit.
Right. So speaking of which, you have guided for an 800 store addition for FY27, including the franchise outlets. Can you give some color on the growth guidance, the revenue guidance thereof?
No, I'm not sure. I think we'll probably have it in the investor calls. I think that's for the CFO to give you guys any guidance. On the store itself, yeah, we have, I think, added around 146 stores. We'll probably continue to add at a similar level, and we'll catch up in the last quarter, and we'll easily be able to meet the 800 stores, which we said we'd actually add this year.
Also, you flagged early franchise closures on expectation mismatch. How serious is this churn, and what guardrails are you putting in place for the new partners?
So a couple of things. It's not necessarily expectation mismatch. It is also a problem of, franchisees being able to find the right kind of employees to run the stores. We are taking steps to make sure that we are able to train and keep ready some people who can come and actually work with these guys. So that will be taken care of. It's a new model, and that's why we have been saying it's a pilot thing. We are, still experimenting with that. There's several things which we have to still tweak. It is the process. If it are already done, then we would be doing far higher than what we are. We're positive it'll work well. Still not 100% ironed out all the kinks.
Right. You've also called quick commerce unsustainable at current economies. How does MedPlus plan to defend the pharmacy market share as the 10-minute delivery platforms now move into this category?
See, our main thing has always been availability, getting all the medicines, genuine medicines, the full basket, and also making sure that we are able to give people the highest possible discount. So as I said earlier in the call, if someone were to figure out how to basically do this, give a 20% discount or more, deliver in 10 minutes, and also have the full availability, we'll be more than happy to copy it. I don't think, our stores, we have 400, 450 stores in every city in which we operate. We can easily convert them into dark stores and do exactly what everyone else is doing. I don't think it's the technology or it's the app or whatever it is. We're not too concerned. We don't think this is a thing which will, run profitably. If it does, I see no problem in copying it.
Right. Also, Mr. Reddy, the diagnostics is growing slower than the internally targeted, and the radiology expansion is paused. Is this vertical being quietly deprioritized?
Yeah, I wouldn't say deprioritized. In the current form in which we actually wanted it to run, at least in which I envisaged it when we launched it in 2022, I wanted it to be a subscription-based model in which a city like Hyderabad would have at least 250 to 300,000 members in the first 1 or 2 years. And by now it should have been at least 300 to 400,000 members at least. Given that we're still not there, and largely because we have not been able to get the B2B customers on board, we think that we will probably tweak it a little bit, run it. It's not going to be shelved anytime soon, but it's going to run profitably till, we can figure out a way of actually growing it. But right now, in the current, let's say stage at which it is, I don't see us basically going and investing more money into it.
All right, Mr. Reddy, on that note, thank you so much for taking the time out and joining us and giving us a sense of the growth roadmap ahead and weighing in on the numbers. Thank you so much for joining us. It was a pleasure to have you on the show.
Thank you. It's a pleasure.
All right, with that, it's time for a quick breather. Don't go anywhere after the break. We'll come back and give you more updates on the market. Stay tuned.